Ever wondered how to tap into your home's value without selling it? A HELOC, or Home Equity Line of Credit, might be exactly what you're looking for. But before you sign anything, let's break down exactly what it is, how it works, and what you need to know as a first-time borrower. A HELOC is a revolving line of credit secured by your home. That means you can borrow money against the equity you've built, kind of like a credit card but tied to your house. For example, if your home is worth $400,000 and you owe $250,000, you've got $150,000 in equity. A lender might let you borrow up to 80–90% of that, minus what you still owe. So how does it work? HELOCs usually have two phases: the draw period, typically 5 to 10 years, where you borrow, repay, and borrow again. You only pay interest during this time. Then comes the repayment period, usually 10 to 20 years, when you can't borrow anymore, and you start repaying the principal and interest. People use HELOCs for things like home improvements, debt consolidation, emergency funds, or even funding a small business. Think home renovations, paying off high-interest debts, covering tuition expenses, or handling medical bills. The key is to use it on things that either increase your home's value or improve your financial position, not for vacations or luxury splurges. Let's keep it real. HELOCs aren't free money. Here's what to consider. On the pro side, you'll usually get lower interest rates than credit cards, flexible borrowing, and if you use the money for home improvements, the interest may even be tax deductible. But always talk to a tax advisor about your situation. On the flip side, HELOCs often have variable interest rates, so your payments can go up. Your home is collateral, so if you default, you risk foreclosure. And don't forget about fees, closing costs, and possible appraisal requirements. Always read the fine print. So how do you qualify? Most lenders want you to have at least 15–20% equity in your home, a good credit score, usually 620 or higher, proof of income and employment, and a manageable debt-to-income ratio. Different lenders have different rules, so shop around. And yes, your home will probably need an appraisal. Here are a few tips if you're thinking about opening a HELOC for the first time. Know your terms. Understand rates, limits, fees, and timelines. Borrow responsibly. Don't max it out just because you can. Have a repayment plan, so you don't get hit with a payment shock later. And compare lenders. Look beyond just interest rates. Consider customer service, fees, and flexibility too. Used right, a HELOC can be a powerful financial tool. But misuse it, and you could put your home at risk. If you're considering one, take your time, read the terms, and consult a trusted lender or advisor. Like, subscribe, and drop your questions below.